Welcome back to Startup Accounting 101. It's a video series for founders to understand accounting fundamentals for running a business. We are moving through the financial projections template. It is available from score.org. Go to their template gallery and download the file. I'll have their link in the description below. This video, we're covering tab 8, which is the balance sheet. And the balance sheet is the last of the major financial statements of a business. We've already covered two. We have the statement of cash flow here and the income statement. So the balance sheet is a third of the major financial statements. The other two we've covered already, cash flow and income statement. They cover a period of time. So the income statement for the year, it covers, January 1st to December 31st, like all the activity for that period. It would be the same for the month or the quarter. It would start, 1/1 to 1/31 for January. And for the cash flow, it would be similar. There's like a start date, their end date for the cash balance, and then all of the activity in between these two dates. The balance sheet is a snapshot at one point in time. So the balance sheet in this tab, there are 3 years. It covers 3 years. And this would be the year end for those respective years. So it would be 12/31/2025. It would be the same date for all three. If you were putting together financials like halfway through the year, if you needed like interim financials, you would take the balance sheet as of like the last date of those financials. So, half a year would be June 30th. So the best way to think about balance sheets is that they're basically the net worth of the statement. So just like your personal net worth is just a snapshot of your financial health at one point in time, the balance sheet is the equivalent to a business. So we're going to look at two examples of a balance sheet. So on the left is the template. And then on the right, it is a sample balance sheet. First thing would be, why is it called a balance sheet? And the main reason is because this particular statement, the sections must be in balance. So there's an equation that shows which sections must balance. So here we have, assets equal liabilities plus equity. Now on this sample balance sheet, I have is a really good sort of visualization of the concept. So we have, assets here. Oops. So we've got assets on the left side, and that equals liabilities here plus equity. So these two sections of the balance sheet must equal the assets. So here, there's a typo here. So the total assets 774,400. And it should say total liabilities plus equity is also 774,400, where 300 of it is equity, and then 474,400 is liabilities. And on the template side, we have actually a section here. If I can get to it, it's not gonna let me do it, huh? Okay, so there's this section here that asks, is the balance sheet in or out of balance? So right now, everything is balanced. But if I go in and change something, like if I just add $100 to AP or accounts payable, it gives a warning saying the balance sheet, it is not in balance. So whenever that happens, if you're putting together forecasted balance sheet, which you might have to do through Excel, if it's not balanced, then you're going to have to investigate, what's happening, what could be the issue, and it could be, it could be a formula issue, it could be a manually keyed number, just like what, I just did, just put in a number, and I'm just going to reverse this to keep this in balance. It could be that, the wrong cell is linked. So if I go up here, like let's say I change the cell reference to a different cell, it is also out of balance. So I need to sort of investigate as to what might be happening, and the wrong cell was linked in the balance sheet projection. So if I put it back, everything is now in balance. So I think let's get started and review the different sections of a balance sheet. So if we come to the top, there's current assets. And so current, by definition for the balance sheet, anything that's current, whether it's on the asset side or the liability side, current means that it will be converted or could be converted into cash within 12 months. So on the asset side, all of these things that sit within the current asset section, so here and here on the template side, they likely can be converted into cash within 12 months. So these are your fairly liquid assets for the business, and these are the most common types of current assets. We've got all of the cash accounts, so checking, savings, accounts receivable, inventory, prepaid expenses. Those are the top current assets. And after this section comes any sort of long-term assets. So by definition, anything long-term is on your books for more than 12 months or 1 year. So any investments that you have in another business would be long-term assets. The next major long-term asset would be fixed assets, or PP&E, plant, property, and equipment. And within this section, there's accumulated depreciation here, or like the use of the fixed assets. So they'll bring down the value of these assets over time, and eventually, when everything is fully depreciated, the value of the fixed assets section as a whole would be zero. Once everything is fully depreciated, the net amount would be zero. And then the last set of assets could be intangible assets. So if you have intellectual property, goodwill, trade names, that will go under intangible assets. And there might be other assets that don't fit anywhere else and that would fit here. And so each section has its own subtotal, and as a whole, the total assets will have a subtotal for each year. If we head over to the liability side, so the current liabilities, by definition, are any debts that you will have to pay in cash in the next 12 months. So the top is usually, you will usually start with payables. So accounts payable, or any other forms of payables. It could be notes, wages, interest, any sort of payables. Lines of credit will sit within the liability section, and unearned revenue. So these are the top types of current liabilities. Then we have long-term liabilities, which I guess the template side doesn't split out between current and long-term liabilities. So some of these loans, if you keep the balance for more than 12 months, it would be long-term. So on the sample side, like notes payable comes twice. That probably means the total, the amount due is probably $20,000, but this $5,000 amount is due within 12 months, and then the rest of the balance would get classified under the long-term liabilities section, even though they may be referencing the same like loan account number. It's split out for presentation purposes. So we have a liability section. They will have a subtotal for each. And then we have finally the equity section. And the equity typically has stock. It could be common stock, preferred stock, retained earnings, and then any sort of withdrawals from the business. So they could be in the form of dividends, an owner draw, or a treasury stock buybacks. So this would all go under equity, and we have a total amount here under equity, and then both of these together will always equal the total assets section. And both balance sheets are in fact balanced. When I look at the template side, everything actually looks pretty good. But I do notice that there is a line of credit balance here. And our cash balance is pretty robust. It has pretty high balance, more than enough to cover the line of credit. So with that, I guess we can go ahead and pay down the line of credit. So if I go back here to the cash flow, I can see that the line of credit balance on the final row 33, and this is the ending cash balance. So here I can say I want to repay it back in November because we got $150 in the bank. That's a pretty robust amount there. So we can just knock out that loan. And if we go back to the balance sheet, here, year one, as we're building the business, we had to draw for that line of credit. Before adjusting the income statement, there were like negative profits. So this balance was pretty high, but since that adjustment and scenario planning, we've righted things. So now we have a balance sheet that's pretty robust. And with that, I guess we've completed the balance sheet and all the financial projections. The next few videos will cover various like analytical and like diagnostic tools. So like and comment if you enjoyed this video. Please subscribe, and thanks for watching.